Keel Infrastructure Corporation, trading under the ticker symbol KEEL on the NASDAQ, is currently trading live at $4.82 per share, up nearly 11% during today's session on elevated trading volume. While retail traders across popular trading platforms are flocking to buy the stock following a government-backed mega-project announcement and new Wall Street coverage, a glaring gap exists between what the market expects and what the underlying financial realities actually reveal. Investors looking at the ticker right now see a company riding a massive wave of excitement surrounding artificial intelligence data center infrastructure. Wall Street analysts at firms like BTIG and Citizens JMP have issued fresh buy ratings with price targets ranging from $8 up to $10 per share, suggesting the potential for significant upside. The consensus expectation is simple. This company holds a massive power pipeline of 2.2 gigawatts across key North American energy grids, making it a prime candidate to sign lucrative long-term co-location contracts with tech giants and hyperscalers. However, the reality beneath this narrative tells a far more complicated story. While the stock has seen a sharp rally over the last 48 hours, it remains significantly below its peak of over $7 reached just a month ago. The market is celebrating raw power capacity, but it is underestimating the immense capital destruction and execution hurdles happening behind the scenes. Over the past quarter, the company reported under $37 million in top-line revenue, while burning through millions in cash and registering a staggering net loss. For retail investors using Robinhood stock trading, SoFi Invest, or checking quotes on the Fidelity mobile app, this stock looks like a cheap way to get exposure to high-performance computing infrastructure. But when you examine the balance sheet, you find over $500 million in debt sitting against a cash reserve that is rapidly shrinking as facility upgrades drag out. The recent daily swings in Keel Infrastructure Corp stock reflect an intense tug-of-war between retail momentum and institutional caution. Trading volume spiked dramatically above its 50-day average as news broke that municipal authorities approved power consolidation for its flagship data center campus in Sherbrooke, Quebec. Short-term traders saw the headline and rushed into individual brokerage accounts on Interactive Brokers and Robinhood, driving the share price up in rapid succession. Yet if you read the actual disclosures, the municipal approval is only a tiny step in a long process. The land purchase for that flagship site is not expected to close until early 2027, and provincial regulatory approvals remain pending. That creates a massive timeline mismatch. Investors expecting immediate revenue generation from these facilities are facing a multi-year waiting period, during which the company must continue funding heavy capital expenditures. This dynamic is creating high volatility in the options market and across major trading platforms. Institutional sentiment is divided. On one side, fundamental equity analysts looking at sector momentum recognize that power capacity is the ultimate bottleneck for artificial intelligence deployment. With major tech firms competing aggressively for gigawatt-scale sites, any firm with established grid interconnections holds valuable real estate. On the other hand, risk managers looking at fixed income metrics see a firm with negative gross margins, substantial cash burn, and a heavy debt load that may eventually require dilutive equity offerings or convertible debt issuance to survive. In fact, earlier this summer, the company raised $400 million through a convertible notes offering just to stretch its liquidity runway. To understand how Keel Infrastructure Corp reached this inflection point, one has to look at its origin story. The company previously operated under the name Bitfarms Ltd., working primarily as a Bitcoin mining enterprise. During the peak of the crypto cycle, the company acquired massive power purchase agreements and built data centers across Pennsylvania, Washington, and Quebec. However, as crypto mining margins compressed and the computational requirements for artificial intelligence exploded, management realized their most valuable asset was not their mining rigs, but their electrical interconnects and power access. Earlier this year, the company completed a complete corporate rebranding, changing its name to Keel Infrastructure Corporation to signal a strategic pivot away from volatile cryptocurrency rewards towards steady, long-term, high-performance computing co-location contracts. It is worth pausing here to ask a direct question to everyone watching and tracking this ticker. Comment below how many shares of Keel Infrastructure Corporation you currently hold in your portfolio, or whether you prefer investing in established tech giants like Nvidia stock, Apple stock, or Tesla stock instead. When you look at self-investing strategies today, many investors build portfolios through automated tools like Schwab Intelligent Portfolios or browse Fidelity mutual funds and Fidelity ETFs looking for stability. Others preferred direct online investing through SoFi Active Investing account or Interactive Brokers stock trading, taking aggressive positions in high beta turnaround plays like this one. But turnaround plays require flawless execution, and that is where the expectation versus reality balance becomes critical. The bullish narrative relies on the idea that Keel will sign a major hyperscaler to a 20-year lease, instantly validating its power pipeline and transforming its financial profile overnight. The bear case argues that while the company waits for those deals to materialize, high interest rates, operational burn, and construction delays will erode shareholder value. Looking ahead at future catalysts, the immediate test for Keel Infrastructure Corporation will be its upcoming financial disclosures. Investors will be scrutinizing whether the company can stabilize its operational cash flow while advancing its pipeline in Pennsylvania and Washington. If management manages to finalize its first major co-location agreement with a recognized enterprise or cloud provider, the stock could easily retest its highs near $7. Analysts who cover the stock on Fidelity research portals or through SoFi Stocks research feeds maintain an overall buy rating precisely because they believe power assets are rare and valuable enough to overcome short-term balance sheet distress. However, if project timelines slip further into 2027 or 2028 without confirmed revenue-generating leases, market patience will wear thin, and the stock could retest its previous multi-month lows around $3.80. Macroeconomic pressures also play a significant role. Interest rate movements directly impact the cost of capital for infrastructure builders. Building out data centers to support high-density graphics processing units requires billions of dollars in equipment, cooling systems, and substation upgrades. If interest rates remain sticky, financing these build-outs through debt becomes increasingly expensive, squeezing margins before a single megawatt of power is sold. On the flip side, if central banks begin easing monetary policy, capital-intensive infrastructure stocks often experience a sharp valuation expansion, as cheap debt makes large project build-outs far more economical. When evaluating your overall investment strategy, seeking solid investment help and using proper risk management across your individual brokerage accounts is essential. Whether you execute trades through the Robinhood app, manage long-term wealth through Fidelity Wealth Management, or trade active positions on the Interactive Brokers platform, position sizing remains key. Speculative infrastructure pivots carry significant binary risk. High upside potential always comes attached to substantial execution exposure. In summary, Keel Infrastructure Corporation stands at a critical juncture. Market expectations are driven by a powerful narrative of artificial intelligence power demand and strategic infrastructure assets. The underlying reality reflects a business in the middle of an expensive, complex transition from Bitcoin mining to enterprise computing. The company possesses real, valuable grid connections across key regional markets, but turning those connections into profitable co-location revenue will take time, capital, and regulatory hurdles that many short-term traders are currently overlooking. As trading continues today at $4.82, the key metric to watch over the coming quarters is not just stock price momentum, but concrete contract signatures and execution speed on site developments. That is the real metric that will determine whether reality eventually catches up to the market's high expectations.